The Airbus A340 was supposed to be dead, a four-engine relic from the 1990s, retired by nearly every major airline. Air France scrapped. Virgin Atlantic all-new aircraft. But Lufthansa, they're still flying 22 of them. In 2025, that's almost unthinkable. Fuel-hungry, maintenance-intensive, environmentally unfashionable. In 2025, everything about the A340 screams retirement. Yet, Lufthansa isn't hanging on out of nostalgia. They've turned these aging quad jets into money-making machines. So why did Lufthansa succeed where others failed? What do they know that other airlines don't? The Airbus A340 ruled the 1990s as the king of long-haul travel. Four engines meant unrestricted range when ETOPS limited twin-engine jets to 90-minute diversions from airports. Then everything changed. ETOPS rules relaxed. The Boeing 777's twin-engine efficiency reshaped the industry overnight. Later, airlines pivoted to 787s and A350s, burning less fuel than four-en jets. Airbus halted A340 production in 2011. The market had spoken, yet Lufthansa, the A340's original launch customer, kept flying them. As of September 2025, they operate 16 A340s and 6 A340s from its Frankfurt and Munich hubs. The fuel burn numbers are brutal. The cost per seat mile is staggering. Maintenance stings even worse. Four engines means basically double the maintenance costs versus twin-engine jets. Cargo capacity lags too. An A34600 carries up to 30 containers, while a Trip 77300ER holds 32, leaving revenue on the table. Environmental pressure adds heat. European regulators demand lower emissions. Four-engine jets, they don't really help the optics. So why hasn't Lufthansa grounded these planes like everyone else? The answer lies in three strategic advantages. Competitors simply cannot replicate those fuel-burning A340s, their fully depreciated assets. Lufthansa owns them outright with zero debt service. At list prices, a new A351,000 costs around $350 million with monthly payments running in the millions, even with airline financing deals. An owned A340 that costs zero in capital expenses. That fuel penalty per flight suddenly looks manageable. When you're saving millions in aircraft payments, the pandemic proved this strategy brilliant. When travel demand surged back faster than expected, airlines globally faced capacity shortages. New airline deliveries were delayed for years. Stored aircraft took months to return to service. Lufthansa, they had ready capacity sitting in their fully owned fleet, but depreciation alone doesn't explain how they make foreign economics work. There's a deeper secret that separates Lufthansa from every competitor. Lufthansa deploys A340s exclusively on premium heavy routes, packed with business travelers willing to pay $4,000+ for round trips. The A34600 cabin is a revenue powerhouse, 8 first-class suites, up to 56 business-class seats, 28 premium economy, and 189 economy seats. The A340's 242 economy layout offers wider seats and a quieter cabin. This passenger comfort advantage helps Lufthansa attract premium travelers on high-yield routes despite the aircraft's age. These aircraft target Frankfurt to Boston or Los Angeles, routes where schedule reliability and product quality matter more than fuel efficiency. High-yield passengers don't optimize for fuel burn. They optimize for convenience and comfort. That premium focus, it generates enough margin to absorb fuel penalties and maintenance complexity. Meanwhile, Lufthansa operates 19 Boeing 747-8s, the world's largest passenger fleet of these fueling jumbos. Same strategy. Premium routes where cargo revenue from 38 lower deck containers adds serious cash flow. The 747's iconic status creates a branding edge. Passengers book the Queen of the Skies for its legend, giving Lufthansa marketing value competitors can't replace. But premium routing still doesn't solve the fundamental maintenance cost problem as aircraft age. That's where Lufthansa's secret weapon comes into play. This is the game-changer that makes everything possible. Lufthansa Technik is one of the world's largest aircraft maintenance organizations. It's wholly owned by Lufthansa Group. While competitors outsource heavy maintenance at premium rates, Lufthansa does everything in-house for aging aircraft. This advantage becomes massive as global support for A340 and 747s declines. Parts become scarce, and specialized knowledge disappears from the market. But Lufthansa Technik maintains expertise and inventory that competitors simply cannot access economically. The cost differences are staggering. Simply put, external maintenance for an A340 engine overhaul costs more. Parts availability becomes crucial as aircraft age. When manufacturers discontinue support, airlines face massive costs sourcing components or risk aircraft groundings. Lufthansa Technik stockpiles critical parts to ensure the fleet continues to fly. This creates a virtuous economic cycle. Lower in-house maintenance costs make older aircraft viable for extended service. Extended service generates more revenue from fully depreciated assets. Higher utilization justifies continued parts inventory and expertise investment. Other airlines simply cannot replicate this advantage without building massive maintenance infrastructure. The upfront investment would cost billions with uncertain returns. Now, Lufthansa's A340-600s are planned for retirement in 2026, delayed only due to slow Boeing 787 deliveries. This isn't a rushed exit. It's time to align with new aircraft arrivals. 10 A350, 100S, and additional 787s start arriving from 2026, offering similar capacity with better fuel efficiency while ensuring a smooth transition to twin-engine efficiency without premature asset write-offs. The 747-8 will keep flying into the late 2020s with cabin upgrades to stay competitive. Lufthansa Technik's unique maintenance edge makes this extended service life possible, while competitors write off similar aircraft as obsolete. But Lufthansa's A340 strategy still carries real risks. In eco-conscious Europe, flying four-engine jets draws scrutiny as regulations tighten. EU's Corsia and sustainable aviation fuel mandates alongside stricter emissions targets could increase A340 operating costs. If SAF adoption lags, fuel price spikes could squeeze margins. Aging A340SI also face reliability risks with potential for costly repairs or groundings as parts wear out. But Lufthansa's betting that its sustainability projects and premium revenue from A340 routes outweigh these challenges, buying time for their transition to modern twins. In aviation, efficiency isn't just about fuel burn per passenger, it's about total cost per available seat mile, including capital costs, maintenance expenses, and operational flexibility. When you own aircraft outright and maintain them in-house, the economics completely flip. Those fuel-hungry engines become tolerable. When you're not paying aircraft financing, higher maintenance complexity becomes manageable when you control costs internally. Lufthansa essentially created a parallel business model where depreciated assets generate cash flow that competitors can't access. The strategy works because they control three critical variables: capital costs through ownership, maintenance costs through in-house capability, and revenue optimization through premium routing. Remove any one of these advantages, and the A340 becomes an economic disaster. But combine all three, and you've got profitable operations from aircraft the industry considers obsolete. When you strip away emotion and look purely at the numbers, Lufthansa's strategy makes perfect sense. They're extracting maximum value from sunk investments while building toward an efficient future fleet. The A340s and 747s represent billions in historical investment. Writing them off prematurely means abandoning potential cash flow to chase efficiency metrics. The airline's maintenance advantage creates competitive modes that justify extended aircraft life. Lufthansa Technik's capabilities let it profitably operate aircraft that would bankrupt airlines paying market maintenance rates. The premium route focus, ensures revenue generation matches operational costs. High-yield passengers on business routes generate enough margin to absorb fuel penalties and maintenance complexity. This isn't about loving an old aircraft. It's about financial engineering that turns aging assets into profit centers. In a few years, these aging quadettes will be museum pieces. But Lufthansa is proving that sometimes the most counterintuitive decision reflects sophisticated financial strategy. The airline is not just operating old aircraft. It is monetizing strategic assets in ways the industry didn't think possible. The A340 era is ending. But Lufthansa is making sure they extract every possible dollar before that final flight. And that demonstrates the power of turning conventional wisdom upside down.